Why investors are quietly moving into physical silver. You're watching a moment in financial history that most people will only understand years from now. February 2026. Gold is hovering near the $5,000 level. Silver has surged into ranges that, just a few years ago, analysts considered impossible. Prices swing violently, sometimes rising in explosive bursts, sometimes collapsing in single-day shocks large enough to erase months of gains. This is not normal volatility. This is not a healthy market finding equilibrium. This is the sound of a system straining under forces it was never designed to absorb. Because what is happening in precious metals right now is not just about metals. It is about trust. It is about debt. It is about the slow erosion of the monetary system that has governed the world for decades. And the quiet shift now underway, the movement into physical silver, may be one of the clearest signals that something deeper is breaking. Now we need to talk about the first signal most people are ignoring. Gold and silver are rising together during periods when, historically, they should not. At the same time, equities in certain sectors remain elevated, debt issuance continues, and government deficits expand. Under traditional economic rules, these conditions cannot coexist indefinitely. Rising real yields should pressure metals. A strong dollar should suppress commodities. Risk assets should not rally alongside safe havens. Yet, here we are. This is where the pattern breaks. Markets are no longer behaving according to classical relationships because classical relationships assume stability in the underlying currency. When the currency itself becomes unstable, correlations collapse. And that is precisely what we are seeing. This brings us to the deeper cause, the engine driving everything beneath the surface. Global debt has reached levels that are historically unprecedented, exceeding $340 trillion, several times global GDP. This debt cannot be repaid in real terms. It can only be inflated away. Central banks know this. Governments know this. Institutional investors know this. And slowly, quietly, capital is adjusting. Central banks have been purchasing gold at near record levels, extending a multi-year accumulation trend that is reshaping the global reserve landscape. Major financial institutions now openly speak of a coming capital war, driven by debt, geopolitical tensions, and weakening trust in fiat currencies. When the largest pools of capital in the world begin preparing for monetary fragmentation, the signal is unmistakable. But gold is only part of the story. Silver is different. Silver is smaller. Silver is more volatile. And silver is far more fragile structurally, which is precisely why what is happening in silver is so revealing. The silver market has been running persistent structural deficits for years, with demand exceeding mine supply by tens or even hundreds of millions of ounces annually. Industrial demand, from solar panels, electric vehicles, electronics, and AI infrastructure, continues to climb, drawing down inventories and tightening supply chains. At the same time, global inventories in major trading hubs have been shrinking, while annual demand dwarfs available stocks. This is not a temporary imbalance. This is structural. And when a structural deficit meets rising monetary fear, the result is not stability, it is stress. Now we need to talk about the signal that makes seasoned observers uneasy. It is not the price, it is the behavior of the physical market. Lease rates have risen. Backwardation has appeared. Physical premiums in some regions have diverged from futures prices. These are not headline-grabbing statistics. They are plumbing signals, deep infrastructure indicators of stress. They are the financial equivalent of pressure building inside a sealed system. In such environments, paper claims and physical assets begin to separate. The paper market continues trading smoothly. The physical market tightens quietly. And slowly, the credibility gap widens. This is where the system breaks, not in a dramatic overnight collapse, but in a gradual erosion of trust as metal flows out of vaults and into private hands. This is why investors are moving into physical silver quietly, not loudly, not publicly, quietly. Because the moment a crowd notices a structural shortage, the shortage accelerates. Now we need to look beyond Western markets because the confirmation is global. China has restricted exports of physical silver, tightening supply to international markets, and increasing pressure on inventories in London and Zurich. Emerging economies facing currency instability are seeing ordinary citizens turn to precious metals as a last line of financial defense. In countries where banking systems have collapsed or trust has evaporated, gold and silver are not investments. They are survival tools. This is not theory. This is happening now. And it is spreading. At the same time, the industrial world is consuming silver at a pace that mining cannot easily match. Renewable energy infrastructure alone requires vast quantities of silver, and electrification trends are accelerating rather than slowing. The result is a market squeezed from two directions simultaneously: industrial demand from one side, monetary demand from the other. Few markets can withstand that kind of pressure indefinitely. This brings us to the most dangerous signal of all, the lagging asset, currencies themselves. Most people still measure wealth in nominal terms. They see rising asset prices and assume prosperity. But when everything rises together, commodities, housing, equities, metals, it is not a sign of strength. It is a sign of currency dilution. Assets are not becoming more valuable. Money is becoming less scarce. History has shown this pattern before. In the 1970s, commodities surged as inflation eroded purchasing power. In Weimar Germany, asset prices rose not because wealth was being created, but because currency was collapsing. And in countless emerging market crises, the final phase was always the same. People moved out of financial assets and into tangible ones, not because they wanted to speculate, because they wanted certainty. This is the psychological shift now underway. Investors are not rushing into physical silver with headlines and television interviews. They are doing it quietly, because those who understand systemic risk rarely announce their moves. Now we arrive at the final verdict. What we are witnessing is not a normal commodity cycle. It is a monetary transition. The old system, built on ever-expanding debt, low rates, and confidence in fiat stability, is reaching its limits. The new system has not yet been born. And in the space between those two realities, volatility becomes extreme, correlations break, and physical assets begin to behave differently from financial ones. Time itself becomes the enemy. Settlement delays lengthen. Liquidity evaporates suddenly. Prices gap overnight. And the illusion of stability vanishes faster than anyone expects. Doing nothing in such an environment is not neutral. It is a decision to remain inside a system that is changing faster than most people can perceive. Years from now, analysts may look back on this period and say that the warning signs were obvious. The debt levels, the central bank buying, the structural deficits, the tightening inventories, the quiet movement into physical metal, all of it was visible, but only to those who were paying attention, and you are witnessing it now.